developers. And of course, we built, a network of partnering media channels across the Russian-speaking countries, because apparently originally we're coming from there. With venture side, we've done about 60-something deals, early stage and private rounds, investing about a tiny amount of $24 million, which turned into so far 56, with 18 million still in contracts sitting and waiting when the tokens will be vested. But some of the list of the projects that we've invested early stage are listed here on the screen, with including Polygon, 1inch, The Graph, Mina, Casper Labs, and some other guys. With Berezka DAO, this is something that we're doing since mid-2019, and we are one of the, well, let's say, prominent liquidity providers, although not with like huge amounts of capital, but from our part of the world it is. Having 10 DAO products with 8 million locked in different assets, 5 million of which is in stable coins, which means that we're really proud and actually managing stable coins and giving the same API, which is the returns on the stable coins across different DeFi protocols. So having said all that, when we move into the DeFi space, it's always difficult to explain to various crowds what it is and where it is heading to, because the level of understanding is usually very different. So if you allow me to go from like very beginning and start from the fundamental layers and go step by step to see where we're sitting at the moment, again in our opinion, and where we're heading to, at least with us as the venture fund, where we're looking to, what type of projects we're searching for, and where we invest. So it all definitely started with blockchain when it appeared with Bitcoin and the first coins. And that literally provided us as users an opportunity to hold our money outside of the banking system. The only problem with that was volatility, apparently, right? Because even if you move your assets from your traditional bank or a broker where you store your money, you would not sleep well, right? Because the prices would jump like crazy, and you may lose. It's just not comfortable. So that led to the situation when stablecoins appeared, first with the fiat-backed versions of Tether, USDC, and all the other guys, and of course later on with algorithmic stablecoins, including DAI and all the other. And what they did, of course, is they helped us to not only store our assets and money, liquid assets, right, money, outside of the banking system, but also sleep well, because we now can understand that, okay, I can keep my dollars actually on my wallets 24/7 and do something with it pretty much flexibly. But the next step, of course, was that, okay, so if I move this money away from the banking sector, why don't I have some simple ways of earning simple interest, maybe on deposit-like products on blockchain? So in order to find such solutions, of course, the focus came onto the centralized exchanges, because for years they have been servicing pretty much like over 100 million clients now, providing two types of services, right? Switching or allowing to swap tokens, crypto tokens one for one, one for another, and lending. Your traditional lending, you can go on Binance, you can go on Huobi, and you can deposit your assets right now and get some yield at the moment. Or you can also lend against your cryptos there. So this has already been working. And with the coming of centralized lending platforms, of course, that were gaining traction all over the time, some of the developers were looking into this, and they started to understand, okay, we have the centralized platforms, we don't know how much money they're making, but we understand the limitations of them as well, right? Because it's still centralized. So we all have all these KYC and AML issues that are changing over time, right? So if you go through them once, it doesn't mean that you would not be blocked in the future, because it may change. Then every now and then you get some blocking on your accounts, right? You cannot withdraw your assets. You cannot, you get assets frozen and whatever. And then of course you have some flash crashes internally for professional players, where the price of Ethereum or Bitcoin might be, at a certain level, but then for some reason within the centralized exchange, it would just drop dramatically. That something that happened even this year on Kraken and has been repeatedly happening on BitMax and so on, right? Leading all the professional investors to like multi-million-dollar losses, and that was painful. So apparently the first decentralized solutions that appeared as DEXs, basically your decentralized exchanges and decentralized lending platforms, they were offering pretty much the same thing for the users. They're saying, guys, same story. If you want to exchange, if you want to swap one token for another, you can go to a centralized exchange or you can go to a DEX. And you can do it exactly the same way. So just connect your Web3.0 wallet, swap it, and just go. No limits on volumes, on times, no delays or blocking of funds and whatever else. There are some technical things that you have to be aware of. Apparently, you have to need to do your own due deal, track your historic APIs and so on and so forth. But still, there's no there's like freer world in a way, I would say. But then on the other hand, these new solutions started to influence the appearance of a new group of people that are now called liquidity providers. So basically those guys who were out of the game because the centralized platforms apparently were making this, making all this money from the exchanges, from the lending for their beneficiaries, which is normal, right? So right now, the decentralized exchanges and lending platforms, they're saying, guys, you can provide your liquidity to our platform and you can earn as if you were part of our owners. The terms and all the other conditions, of course, you have to search for yourself. So, but technically, it would be as easy as just swapping your tokens, right? So you move your funds on your MetaMask, you connect it to the platform, you send your funds to this or that liquidity pool. In return, you receive some what they call liquidity pool token. So that means that your wallet is never empty. And anytime you want to switch it back and withdraw your funds, you just send your LP token back to the smart contract and you receive your funds back. So it's very easy. No need to deal with any people, any support. It's just the smart contract that you're dealing with. So with the appearance of first decentralized exchanges and lending protocols, it became apparent that the centralized guys, exchanges and lending protocols, they were making huge profits because these guys started to see that, hey, if I provide my stable coins, I can actually yield double-digit returns annually, which is crazy, right? And that's why new protocols were coming like crazy. You can see it on DeFi, DeFi Pulse resource, seeing this, more and more people, more and more projects, and more money just flowing into this market. And apparently, as more projects were coming in, they started to fight for consumers, right? Because there's competition. I mean, how many DEXs you need? How many lending protocols you need? So that led to the two phenomena that are known as vampire attacks and farming, which actually, in a way, they go together. First thing, of course, is well, when a new DeFi project comes out, apparently what it does is it targets a successful player that is already in the market, right? And how do you attract the users of this successful player? Of course, you need to provide some higher returns, usually, right? Because we're all here for the business anyway. So what they do is they start to squeeze their margins, trying to provide higher yields. But then the margins are still very thin because you still have to compete with the centralized exchanges and you cannot charge your clients more. So there's only as much as you can provide to actually withdraw and try to lure the guys from the successful business. So that's why a new phenomenon came in as, which is called farming, which in essence is your just traditional cashback from traditional business, right? Or a loyalty program. So where you can have, basically where you can, what you do is you still do provide your capital, right? You still earn your commissions or fees on the lending protocol or on DeFi. But then on top of that, this or that platform, they would now issue and send their own tokens to you. Now, the value of this token, of course, can fluctuate in price, right? We all know that uni token or 1inch token or Wi-Fi or whatever that you can get as a bonus farming token can jump in price, it can go down to zero, right? But then it still doesn't affect your invested principal and the interest and the fees that you earn from the capital that you provide, which is a great opportunity for all these liquidity providers. So drawing, well, basically a comparison from the traditional world, I had this example somewhere and I felt it was like very easy to understand. So imagine if you're a user of Citibank, right? A Citibank client, you have different products there, and for some reason you made a deposit there, right? To earn, for example, some 2% annual yield on your deposit. But then let's imagine that Citibank started to provide a cashback in the form of their stock, of Citibank stock. And you get it on top of your deposit that you made and on your annual yield that you made there. Now, the price of Citibank stock, of course, fluctuates, which means that your returns on the deposit that you made will fluctuate as well. It may go high as the markets would go high, but then if it goes down to zero, this portion of your returns would go down to zero, but that doesn't mean that it would affect your invested principal or the deposit fees, right? Or the yields that you get of the deposits. So that's just like a simplistic way of how to explain what farming is in different protocols. Now, of course, there's different variations and so on and so forth. Now, moving to the present, apparently all this craziness with triple-digit growth, apparently with all these farming tokens that were coming on top of it. And apparently we all understand that all the DeFi ecosystem was being built on Ethereum. It led to the same problem as, that we know exists within Ethereum, right? So the gas prices skyrocketed and the transactions slowed down. So that led to an obvious rebirth of the talks about alternative chains of layer 1 and layer 2 protocols. So tons of these guys, Polygon, XDAI, Polkadot, Avalanche, Binance Smart Chain, and so on, they started to appear, trying to sort of compete for the same liquidity that was happening in DeFi. Binance being probably the largest we know of this for the first, in the first place, because of course they could use or leverage their user base on the centralized exchange. But then, of course, the offer from these exchanges was quite simple. So you just provide low transaction fees and faster speed. That led to the story that, well, of course, all the projects on these new chains, they were forking or copying, I would say, the successful protocols on Ethereum and moving and replicating the same stories on the other blockchains. And to make sure that the money can flow from Ethereum to the new protocols, they all started building bridges or multi-bridges to make sure that the liquidity can flow from one protocol to another. And that is something that's still being built. It's not ideal in a way. And of course, it led to the problems or to the questions of how to store assets, because you need wallets on all these new chains, right? And they should be, at least having the same user interfaces. And then you need some asset management tools that are that we all used to, right, on the Ethereum ecosystem, which are like at least some multi-signature wallets or DAO infrastructure, because lots of funds are actually using these infrastructures to manage their funds, as a community or as teams, or not just as one person holding all the private keys to the wallets. So that leads us to pretty much 5 areas where we see as potential, let's say, developments in the DeFi ecosystem. And us as a fund, we actually actively seeking into, and investigating projects that are trying to solve issues into these five areas. So one of them, of course, is new business models that are now probably not as developed as lending and DEXs or swaps in DeFi, because, DeFi is pretty much about these two things, right? These two business models. So insurance or what we could probably call reverse transactions, something that is being done by projects like Kirobo or Lossless. I don't know if you guys would know it, where you can actually send a transaction and withdraw it back if something goes wrong, for example, and then there's some things that you could build around it. Financial engineering with current infrastructure, which means that if you use the same structure, how do you combine different elements of it to make sure that you still manage the risks, but then you still, you increase your API, you increase your returns. So something that is being done now with Uni V3, I don't know, Uniswap V3, I don't know if anybody's actually using it right now, but it's the functionality is just is incredible. It hasn't been there before. And of course, Shisha Finance or Alchemix, the guys who are actually hard-coded some of their very interesting business ideas into well, basically the ecosystem, trying to provide some additional touch to how do you make money in the current infrastructure. Of course, the multi-chain infrastructure is number 3. Everything that helps you to move assets across chain, right? So the bridges, the wallets, DAO constructors, KYC models, launchpads, and so on and so forth. Fourth, of course, is improving security and reliability, and that starts with auditing, with insurance, apparently, as something that still hasn't picked up. Some ideas of courts within blockchain, because again, MakerDAO is Aragon is playing around with this at the moment, and this is a very interesting idea. And of course, the idea of withdrawing or actually undoing the transactions on blockchain with guys like Kirobo or Lossless is something that's probably worth paying attention to right now. And number 5, of course, is reducing the costs. Still, right, to make sure that you can not only compete with the centralized exchanges and lending platforms, but actually with the banking system and so on, to make sure that some of the voting can go on snapshot, multi-chain transactions, transaction batching, like you can do with Furu Combo and so on and so forth. So these are the 5 areas that we are looking at, and this probably is it. Thanks for watching and listening.